When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today. And for all the tomorrows to come, ILG's Financial Retire Your Way podcast was created just for you, and it's starting right now.
This is Ron Stutz along with Dave Lopez and the Retire Your Way podcast. We appreciate your listening today. Dave Lopez, of course, the founder at ILG Financial, and we are glad that you have decided to join us today. And Dave, great to be back with you.
Boy, it sure is. It's good to talk to you. I always enjoy our time together, Ron, and I'm real excited about tonight's podcast.
We have a lot of good things to talk about today, and I think our listeners will get a lot out of this. But, you know, it seems like each week there's a new phrase or term being used in relation to the United States economy. Recently, the buzz term floating around is the United States stagflationary debt crisis. We know that any debt crisis can't be good, but what is stagflation? Dave, what exactly does that mean, and how concerned should we all be that will affect us and our plans directly? Stagflation. I've never heard this before until recently in the last few weeks.
Yeah, and this is where we're really dating ourselves age-wise, right? If you were around and actually, actively working and saving back in the 70s, it would have been a term you would have known very well. Mm-hmm. It just hasn't come up since then. But here's the gist of what's kind of going on the financial side. And we've talked about this, by the way, many times, right? Especially recently, this idea of the talking heads on TV and throwing out the buzzwords and the dangers that we have listening, going along with just hearing what they say on the television and jumping onto a buzzword and making a knee-jerk reaction. So when considering your own future plans, really you want to take that information into consideration, but then take a little time to dig down to know what exactly are they saying and what's the other side of the coin. So in order to beat that danger, right, of making a decision based on myth or misinformation, or, if nothing else, just stressing out after hearing something on the news after you make a decision and it's a knee-jerk reaction. What we really want to do, and we say this all the time, is let's just look at the data and the facts to understand, in today's case, what stagflation actually is, what does it mean, and how it might affect us. What do you think of that?
All right. Well, it sounds perfect to me. And you said that it happened back in the 70s. Has it happened? Have we had this term around since then at any time?
That's right, Ron. And we remember and experienced a version of stagflation back in the 1970s. However, the debt ratios were much lower than they are now. The unexpected inflation that came about in the 70s, and it actually wiped out the real value of nominal debts and fixed rates, well, which in turn, it reduces much of our public debt burden. So basically what we're saying is by inflating prices, right, the government's able to actually wipe out some debt. It's actually a technique to wipe out debt. Now, to answer your question, we saw another version of stagflation in that period of 2007, 2008, the financial crisis, which we all remember that well because it's not that far in the rearview mirror.
Exactly.
If you recall, right, we had high debt ratios, both public and private, and it caused a severe debt crisis, right? And that really led to the one we all remember is, for the debt crisis, the housing bubble burst. However, when we're talking about the housing bubble of the 70s, in this situation, the ensuing recession actually led to low inflation, if not total deflation, as opposed to today. In 2008, there was what we call a macro shock to the aggregate demand, right? And today the risks are on actually the other side. They're on the supply side. We don't have enough supply of our products.
Well, tell us, if you would, take a moment and explain how this time around stagflation may be a little bit different.
Right. So we just said briefly, and I know that can be a little confusing what we just talked about on the financial side. So just know that if this is of interest to you, it would be a good indication to call the office and get on the phone with me, and we can talk a little bit more in depth. We're limiting our time here to, roughly the 25 minutes of the podcast. Mm-hmm. So know that we can't go into too much depth on it. But this time around, what we're trying to talk about between the 70s and the 2008 is the stagflation manifested itself with two different negatives. This time around, the stagflation period is poised, at least, to be the worst of both of those prior stagflation periods.
Oh, wow.
So what I mean by that is debt ratios are much higher than they were in the 70s. That's not good, mm-hmm. right? And we have a mix of very loose economic policies, right? That's code for a lot of money printing. Right?
Exactly.
Very mix of loose economic policies and negative supply shock threatening to actually fuel inflation rather than deflation. So an easy way to remember that, Ron, is in 2008 when everything tanked and we started to kind of go into a recession.
Yeah.
What happens is everyone pulls back and stops buying stuff, right? So that prices actually drop because there's not enough borrowers.
Right.
Right. Well, today what's happening is because of all the free money floating around and because of what happened with COVID and people aren't at work, you've got more people who want goods than these companies are able to produce, either because they don't have enough people revved up and employed yet or because of the supply chain disruption. But it's very different than 2008. We have a high demand now, where in 2008 we had a very low demand, which led to deflation. Now we've got not only loose economic policy and high debt ratios, but high demand, which is a recipe for high inflation.
Well, my goodness, this seems like it's really setting the stage for something terrible.
It is, if you understand the numbers, right? Mm-hmm. So for now, these loose monetary and fiscal policies that are in place, they are going to continue. Just have to understand the repercussions. They will continue to fuel an asset and a credit bubble. And again, that's code word. If you know what words to look for just means that's artificially propping up the bond market and the stock market. Mm-hmm. Right. And the longer the loose monetary policy continues, the longer that you're going to see, just against all odds, stocks just seem to keep going up and bonds, the bond bubbles, keeps going up. Right. And housing prices keep going up because it's artificially being maintained by this loose economic policy. So it's kind of like watching a train wreck on our side in slow motion. You know exactly what's going to happen. The only thing we're not completely sure of is the timing of the accident.
Right.
Right. But there's really no way around what the result's going to be here. Right. And I talked to a client the other day and he was asking me to help him get his head around this. And I said, really, it's quite easy to know. If you know enough about the weather, right, you can be on your beach vacation and listening to the radio.
Yeah.
And you know that the hurricane is coming, right? Mm-hmm. And it's going to hit, they even tell you, right? It's going to hit shore tomorrow afternoon at 4:00.
Yeah.
Well, today is sunny. Right. But you have enough data that enjoy the day because I know what's happening tomorrow. And that's kind of what on the financial side we're talking about here is the numbers. We don't have any situation in the past where we can look at what we're doing now and it has had any other outcome than this kind of train wreck that we're talking about. There's no way around what the results will be. Mm-hmm. Right. And there's really nothing we can do to stop it at this point.
Wow. So, Dave, we see the big elements at play and how they worked against each other and get us to this point. But what are some everyday signs that this stagflation is on the way?
Boy, that's a good question. So just like with that hurricane hitting the beach that we talked about, you've got a pretty good idea that it's coming, but, there's some signs on the beach. You can look for the clouds, starting to get darker, right? Even out to sea, you can look for higher winds and higher tides and things like that.
Sure.
We can kind of do the same thing, right? So indicators for us of stagflation, there's quite a few here. One, and you're seeing them now, higher price to earnings ratios on the stocks, right? So if you want more detail on those, again, just call my office. We can kind of talk about that. But it just basically means your stocks are more expensive based on how much a company earns compared to historically. Another one would be low equity risk premiums. Low equity risk premiums is another one. Another one would be, I'm going to go through these kind of quick for time's sake.
Okay.
Inflated housing and tech assets. And everybody's seeing that with the housing prices going through the roof and some of these tech companies going through the roof. Another one would be the crypto sector taking off. And we've certainly seen that, haven't we?
Yeah, sure.
Your Bitcoin and all of that stuff. The other thing you'll see is high yield corporate debt starting to be a little unstable. You'll see collateralized loan and obligations picking up. You'll see private equity picking up. You'll see what they call meme stocks, right? And you've heard that on the radio with like AMC and GameStop. Mm-hmm. You know, that's basically people saying, hey, we're going to start using the stock market independently as gambling. Instead of gambling on the NFL, we're just going to play these games with the stocks. And the reason is right now everything's going up.
Yeah.
Right. So people don't see that as gambling because they really at this point don't think they can lose money.
Right. I don't gamble at all, but I think I'd rather gamble on the NFL.
Yeah, I'm the same way. And then finally, you see runaway retail day trading. And again, you're seeing that on the news with Robinhood and stuff like that. All of those are signs of this unique period of stagflation.
Stagflation. Boy, this may be a new term for you, and we appreciate your listening today on the Retire Your Way podcast with Dave Lopez. And by the way, if you'd like to have a conversation with Dave about any of this, you can call him at 540-720-5656. That is 540-720-5656. That's at ILG Financial. So, Dave, let's take a look at what exactly we can expect to set off this stagflation period.
Yeah, sure. We kind of call it in the office the Big Bang, right? What's going to cause the Big Bang? Well, those loose monetary and fiscal policies that we talked about, remember, they're feeding the asset bubbles.
Yeah.
And they're going to continue to drive consumer inflation moving forward. So at some point, Ron, anxiety is going to start to set in with the government, right? And they will, and you're already starting to see it. They're going to start to put in slightly tighter monetary policies, right? Maybe pulling back on some of the free money stuff. And this will start to trigger the burst, and then will kind of result in the crash. And at least that's our prediction. So whenever the next negative supply shock arrives, right, we're going to officially enter the beginning of this stagflation period.
Right.
So we could expect those shocks to come from, here's an example, renewed protectionism, right? Wanting to just buy U.S., that type of thing. The demographic aging that we're seeing as more and more people leave the workforce, especially spurred on by COVID, right? People, retiring earlier than they thought, right? Which is creating a gap in the workforce.
Yeah.
Immigration restrictions could be what tips it off, right? Reshoring up of manufacturing to high cost regions, right? So we're moving our manufacturing back to places that are more expensive. That could cause it. Or even the balkanization of the global supply chain. So there's any one of a number of these things could tip it off.
Gosh, you put all those things together and it really, Dave, sounds like the perfect storm that's brewing.
Yeah, it is the perfect storm, unfortunately. I hate to be the bearer of bad news. Something else that we're very likely that we will see is central banks finding themselves in what we call a debt trap.
What do you mean by that?
Yeah, so that would be a debt trap would be central banks. They've kind of lost their independence due to the fact that they've been left with very little choice but to monetize massive fiscal deficit to forestall the debt crisis. The government's kind of pushed them in that direction. So because both the public and the private debts are at record highs, right? The banks are going to find themselves in what we call kind of a debt trap. So the government will be, semi-insolvent, which means they won't be able to bail out the banks, right? Or the corporations or the households at that point. And just like we saw they're doing with COVID, for example, right? Yeah. So as we see inflation rising over the next few years, banks will face this dilemma, right? And if they start phasing out unconventional policies and start, raising policy rates to fight inflation, they will risk triggering this kind of massive debt crisis paired with a severe recession.
Wow.
If they maintain a loose monetary policy, there's a risk of double-digit inflation. And with that, the next supply shock would emerge. So we find ourselves in this big big, deep stagflation situation. There's no real easy way out of it. It's kind of like what's going to be the lesser of two evils, and we don't even know which will be worse, but something's got to give. So
well, I'll tell you got me worried about the stagflation thing. It's really, it sounds like it's serious, and people need to give you a call and find out more about it for sure.
Yeah, and the big picture to remember is, there's an old saying in the Bible, nothing's new under the sun. Mm-hmm. We've had stagflation. We've mentioned it twice before, just in the last, 60 years or so.
Yeah.
We're going to survive it. We're not talking about an economy ender, but it's going to cause some pain, especially for those people who don't plan for it. But if you know stagflation's coming, there are things you can do to dramatically minimize the effect it will have on you, your accounts, and your retirement. But you have to recognize it's coming and be proactive to take some actions to protect yourself. And that's really what we're all about here at ILG Financial, which is, building out plans that are going to help you accomplish your goals, even if we have some dramatically negative economic outcomes. Now, of course, we can't guarantee anything, but we can certainly put you in a position where both us on your advisor side and you have a bigger comfort level that some type of an economic catastrophe like this would be very survivable for you. But you have to be proactive.
Well, it does sound like we're headed for a situation that's totally unavoidable. And based on the data that you talked about today, it looks like it's less a question of if and more a question of when.
Yeah, and that's our belief at the firm, that it is a question of when, right? The bottom line is we are overdue for a major economic event or a correction based on over 100 years of economic history. We're not just, making a guess at this. We're just looking at the data. And I know that this data probably sparks anxiety and maybe some fear. Mm-hmm. But remember, we do not have to be afraid of the data. Right? In fact, it's actually the opposite. Thanks to the historical data, we actually have the ability to see things that may be coming our way. And that gives us the freedom and the opportunity to put ourselves in a position to protect ourselves more than if we did nothing. And again, I'm going to go back to that analogy of the hurricane hitting the beach.
Yeah.
Right? If you know it's coming, you can just lay on the beach and hope it doesn't come, because that's easier. And that hurricane's going to come and destroy your house.
Yeah.
Or you can take action, get off the beach, spend the day putting plywood on the windows and protecting the house. It doesn't mean you'll avoid complete damage, but the hurricane will come, just like this economic event, and it will go, right? And the stagnation will eventually pass, and those standing and in the best position at the end of the day are going to be the folks that met with their advisor, discussed the scenario, and took actions to try to minimize the damage to their beach house, so to speak.
What a great analogy there, Dave.
So our takeaway is, Ron, and it's funny, we come to this point every podcast, but I think there's a reason for that. Mm-hmm. Call the office. Let's take a look at where you are. We can discuss stagflation, and based on what you're invested in, we can kind of extrapolate how the possible downsides you could see from stagflation based on your investments, and talk about what you want to do with your life and what you want to use your money for. And then we can make tweaks if necessary. So when the storm arrives, right, you're in the best position for success, whether the storm comes or whether the storm doesn't come.
Well, certainly sounds like folks need to call you right away and have a conversation about all this. The number to call if you'd like to have a conversation with Dave Lopez, 540-720-5656. That is 540-720-5656. Dave Lopez, ILG Financial. And if you'd like to go to the website to find out more, go to ilgfinancial.com. Of course, all that information is there. But 540-720-5656 is your number to call if you'd like to find out more about stagflation, a term that we're all going to be hearing a lot of in the coming weeks and months. And Dave, thanks for sharing all the information with us today.
Yeah, I'm glad. I'm never as happy to do ones that are perceived as bad news.
Yeah.
But again, it's only bad news if you don't take action.
Income, legacy, growth. It's all right here at ILG Financial. And it's about helping you plan for retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656 or go online to ilgfinancial.com to learn more. This has been the Retire Your Way podcast with Dave Lopez. Thanks for listening.
Information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities.